Good day, everybody. This is Overberg Asset Management Market Review. Nick Downing and Werner Erasmus will discuss some updates.
We begin then just a little bit of a view from MRB on the non-farm payrolls. In the US, they say that unless layoffs pick up meaningfully for whatever reason, we are maintaining our overall economic view that following a slowdown this year, US economic growth will return to above potential next year on the back of a positive fiscal policy impulse, looser monetary policy, and a sequentially smaller hit from trade policy. So, in a nutshell, very bullish. It is reasonable, they continue, to expect that investors will be able to look across the valley of near-run economic and earnings softness towards a better 2026. So the news, as I mentioned already, very much about the Federal Reserve. Jerome Powell at the Jackson Hole Central Bankers Symposium acknowledged that an adjustment in the FOMC's policy stance may be warranted. A 25 basis point cut in the policy rate next month, i.e. this month, September, is now back to being almost fully discounted in the money markets. And incidentally, we can look forward to another rate cut of 25 basis points by the Fed in December. Financial conditions show no signs of strains, with the Federal Reserve Bank of Chicago. Their measure signals that conditions are now easier than when the Fed rate hiking cycle began in 2022. So that is quite something. Financial conditions are extremely easy, and that is very supportive of financial markets. A quick look at the dollar. The US dollar has firmed slightly since becoming oversold in the last couple of months. Technical support for the dollar may persist in the near run, but cyclical and longer-term fundamentals remain bearish. The US dollar is still expensive based on most measures. So now we're turning to the cracking second quarter US earnings reports. Second quarter earnings results were strong, with S&P 500 aggregate earnings growing at a 13% year-over-year pace, with annual revenue growth of more than 6%. Roughly 80% of companies reported earnings that exceeded estimates, while 79% surpassed revenue forecasts. The beat rates for both earnings and revenues were the highest seen in several quarters. At the sector level, technology and communication services had the widest breadth of companies that exceeded analysts' earnings estimates. The consensus forecasts imply that S&P 500 earnings growth will slow in the second half of 2025, but then will re-accelerate in 2026. And why is that? Well, of course, it's a full effect of the tariffs may only be seen in the next few months once inventories are depleted and imports pick back up again at the new tariff prices. As more tariff costs are absorbed or passed on to consumers, earnings could underperform expectations. 7 or 8% is incredibly good under any normal circumstances. And bear in mind that analysts have been upgrading their 2026 and 2027 forecasts. Investment strategy outlook. First of all, the global markets. This is from MRB. Nonetheless, let's focus back to the very unusual and highly favorable combination of rising corporate earnings and increasing hopes for low policy rates, especially in the US. The expectation of Fed rate cuts at a time of easing fiscal policies An already exuberant market sentiment has been and will continue to be extremely beneficial for risk asset markets, especially as trade fears are dissipating. Meanwhile, with the oil price, despite historically elevated geopolitical tensions in the Middle East and Europe, a large supply overhang has ensured that oil prices have remained relatively cheap, providing yet another economic tailwind. So really, it's only the bond market that we need to fear. Then lastly, the capital economics view. They are very bullish on the S&P 500. They have the following to say: we are revising up our end 2025 forecast for the S&P 500 from 6,250 to 6,750. It's currently just around 6,400. So there's another 6 or so percent to go, according to their year-end forecasts. And they're now projecting that the index will finish 2026 at 7,250, which is above the previous forecast of 7,000. So they're expecting roughly 8% growth in the S&P 500 in 2026. We began to turn more positive again on the prospects for the S&P 500 in May after the trade war started to de-escalate. Admittedly, there are still plenty of risks when it comes to tariffs. For example, they are likely to cause inflation to pick up in coming months. And it is not yet clear how negotiations with China will play out. Of course, every bull market climbs a wall of worry. We shouldn't worry so much about those issues, but probably focus instead on the more positive issues. But they do concur with MRB that it is also possible the bond market will come back to haunt the stock market, given concerns about the trajectory of US public finances and the Federal Reserve's independence. On valuation, yes, valuations are a bit stretched, and there is a contraction in the S&P 500's equity risk premium, but it is still much higher than the level it reached before the dot-com bubble burst. And then we turn to the local markets.
Morning, Nick. Thanks for that update. So on the local front today, main sectors, macroeconomic overview, which we always covered, a bit of a focus on politics and structural reforms within South Africa. So jumping to the macroeconomic side, we had unemployment for the second quarter being released in August. Unfortunately, unemployment has increased from 32.9% in the first quarter of 2025 up to 33.2%. Yeah, highest reading since 2024 Q2. And then also there was a comment made in terms of imports. It seems like cheap imports from countries such as China and India coming to South Africa also really increasing competition for local manufacturers. Then inflation for July was published in August, coming in at 3.5%. So quite a big jump from the June figure of 3%. And we've been talking about inflation quite a bit during the year and the significant low levels it has been at. The jump was expected. It's mostly driven by municipal rates that has been implemented in July. So if you've got a water and electricity account or account for rates and taxes, you'll obviously see quite a big increase in those tariffs. Then just jumping to politics and reforms, I think this has been quite a big news headline. It was a DA poll that was published last week, and it was in a few news publications, and there was a few discussions around it. I thought it's quite important to mention this. So just some background around this poll. It was a poll by the DA, and both external commentators and other political parties did say that the DA's polls tend to be fairly accurate. There's a national section and also then a section that focuses on metros or local elections, which we all know is due next, closer to the end of next year. So I'm just going to take you through the stats and make one or two comments. On the national level, the ANC, based on the poll, is expected to get 29%, D8 28%, and the MK 11%, EFF 8%, IFP 3%. So just something that stands out is a further drop in the ANC's percentage of the votes. The ANC tends to do better the closer we get to those elections. However, on a local level, the ANC tends to do worse than what polls tend to indicate. And yeah, the local elections are not too far away. So I'll just run you through the big metros. So Johannesburg, Tshwane, Ekurhuleni. Those who don't know where Ekurhuleni is, it's in around the OR Tambo Airport, and then also includes places like Bologna, Boksburg, Springs. And it's a big logistics hub, given its proximity to the airport, and then also there's a lot of manufacturing that occurs in that area. eThekwini is Durban and the surrounding areas, and then also Cape Town. So Johannesburg, I think something that stands out there is the high percentage. The DA is expected to get 40%, and the ANC only 23%. Tshwane, against 27%, DA at 48%. So DA very close to a 50% majority. The DA also having quite a big percentage of the vote, 41%, and the ANC only 19%. Why is that significant? Ekurhuleni tends to be an ANC stronghold, so for them to expect it to only get 19% is quite a big disappointment and a worry. eThekwini, obviously being Durban, KZN being majority Zulu. You'll see the MK there at 31%, the DA with the highest at 44% of the votes, and then the ANC only 14%, which I think would be quite alarming for them. Then on Cape Town, obviously, I think it's quite obvious that DA's got quite a stronghold there. DA expected to get 61%, and then a bit of inroads being made there by the PA at 9%. And I just made the comment that at the bottom, the ANC member that's currently part of Parliament also noted that they received their own internal report that shows that the ANC has got quite a bit of problems in the next local election. So yeah, something to keep an eye on. Then in terms of reforms, there's been an announcement by Business Leadership South Africa in terms of a reform tracker. So it's a tracker that tracks all the reforms currently ongoing in government. And obviously it covers various areas such as water, electricity, ports, local municipalities, so forth. As mentioned before, obviously economic growth this year has been quite disappointing, but the outlook for South Africa, if we look at comments from economists and industry participants, is still positive purely because of these reforms that are ongoing and actually are picking up. There's quite a bit of progress being made in terms of that. So yeah, something positive to note. Then last week, there was also quite a very big announcement by Transnet. And I'll just read a piece here from the Bureau of Economic Research. It's a report we get on a weekly basis. South Africa has taken a major step in reforms in its rail freight system by granting 11 private train operating companies access to Transnet's network. This is the first time in decades that the private players will run services on the state-owned infrastructure, following the National Rail Policy of 2022. Out of 25 applicants, the chosen operators met safety, technical, and financial requirements. The operators will run services across 41 routes in 6 key freight corridors, including coal, manganese, iron ore, containers, and fuel. For example, the North Corridor, and so forth. The reforms are designed to boost capacity, attract private investment, potentially up to 100 billion, and ease pressure on roads by shifting bulk commodities back to rail. Importantly, Transnet will retain ownership of the infrastructure with contracts for private operators lasting between 1 and 10 years. While the move has been welcomed as a step forward, critics warn that retaining Transnet's operational monopoly could limit the scale of reforms, the impact of reforms. So yeah, quite a significant announcement and something that the industry has been hoping for quite some time. We all know the bad state our rail and freight system currently is in. So then just lastly, electricity increase, obviously not a good reform. There's been an increase. There's been a court case between Eskom and NERSA, and Eskom has been granted additional increase of 8.8% in 2026 and 2027. and also 2027 and 2028. So that'll obviously feed into potentially higher inflation.